Welcome to our latest Insider interview. Today in the studio, I have with me Simon Gergel, who is fund manager of the Merchant Investment Trust. Simon, thanks for coming in today.
Hi Carl, nice to meet you.
So Simon, at the time of this recording, the conflict in the Middle East is ongoing. As a fund manager, how have you been approaching the uptick in stock market volatility?
Yeah, well, we've had a lot of volatile periods in the last few years, whether it's COVID, whether it's global financial crisis. I think it's very important as an investor to step back and say, what are we doing? We're trying to buy individual companies that we think are cheap on a long-term basis. And it's quite dangerous it's quite risky to throw around the portfolio to make big changes in the face of quite uncertain events. So we haven't made dramatic changes to the portfolio. We've clearly thought about individual companies and the impacts, but it's hard to know genuinely whether the issues are going to be transitory or permanent or sustained for a long period of time. So we look very much at individual companies, and if we can convince ourselves, or if we believe that each individual company is a sensible investment at the time, there's no reason to make major changes to the portfolio.
And during such periods, is it a case of trying to not make changes as well as thinking about what to do?
Not necessarily, because the dislocation in the market, the movements can create opportunities, both to buy companies that you haven't had a chance to buy before because there are more interesting valuations, and sometimes to sell companies because maybe they get a safe haven status and they moved to too high a valuation. So we may take advantage of the volatility, but we won't generally make massive changes early on in a situation like this, which is evolving rapidly.
Merchant Trust has a notably higher dividend yield than the wider market, the FTSE All-Share Index. However, in total return terms, over both 3 years and 5 years, you have underperformed that index. Could you explain why?
Yes, I mean, the last 2 or 3 years have been quite challenging for our type of value investor. We have found a lot of opportunities to invest, particularly in the medium-sized companies and particularly in the domestic areas. And those areas have been out of favor with investors. The economy hasn't really recovered. And therefore, we've seen those companies get cheaper and cheaper to some extent. And the market's been driven very much by particular themes, whether that's the recovery in the banks sector or the strength of aerospace and defense. And we've benefited from those themes to some extent, but we've not kept up with the really strong market returns in the last couple of years.
You've mentioned financials, which is a key area of the portfolio. Could you talk us through your current exposure, and could you run through your latest thoughts on your banking exposure, given that that part of the sector has had a very strong run over the past year?
Yeah, well, the banks have performed very well over the last year or two, and we've taken some of the positions down a bit to take some profits on those, but they still look decent value. But we've also got a lot of exposure to insurance, whether that's life insurance like Legal & General, some of the reinsurance companies, and also some of the specialist financial companies like Man Group, which is an asset manager, or IG Group, which is a trading business. There's a lot of different opportunities, and we like to have a diversified portfolio, so we're not putting all our eggs in one basket. We're not just investing in one theme or one sector.
You've spoken before about dividing the portfolio into classic value, franchise investments, and special situations. Could you talk through each of those, and could you outline some stocks that fall into those three buckets?
Yes, so the thinking behind that is there are some companies that aren't really growing much. Some industries like oil and gas, or actually banking typically doesn't grow that much. But companies can get very cheap from time to time, and if we can take advantage of that, we call those classic value. You buy them very cheaply, but we're very disciplined about the price at which we will sell them again. There are other businesses which are growing over time and creating value. They're earning a return above their cost of capital, typically strong franchises in attractive industries. Those businesses, the fair value of the business is growing over time. And so, yes, we want to buy them cheaply, but we may run those positions a little bit longer around about fair value because they're growing, their intrinsic value is growing all the time. And the third are special situations, which by definition are quite unusual. They come up from time to time. At the moment, the portfolio is pretty evenly split actually between classic value and franchise, and we've got virtually nothing in the special situations.
And have you been looking at some of the more classic quality growth stocks that have fallen out of favour over the past couple of years? I'm thinking of things like Diageo, for example.
Yeah, I mean, we always look at those types of companies, and very often we are buying companies that have fallen out. So in the last year, a couple of we bought Whitbread, which owns Premier Inn, which has typically historically been quite a highly rated business. We bought Hikma, which is a pharmaceutical company, which again has got a really good long-term growth record. And we bought Reckitt Benckies, or Reckitt as it's called now, which is a consumer staple business, which again has derated. So yes, absolutely, we're looking to take advantage of some of those companies where we're confident that the business is fundamentally sound and valuations attractive.
For an investor who simply bought the UK market via an index fund or an ETF, they've done very well over the past couple of years. So could you make the case for, over the long term, backing an active fund manager like yourself, as opposed to just simply owning the index?
Yeah. Well, I think investors have to be comfortable with what they're doing and what they're investing. What we're offering and what we're trying to do is deliver a high, significant premium income and a growing income that has grown every year for 44 years. And secondly, quite a concentrated, actively driven stock selection approach. So our portfolio is very different to the benchmark, to the index, and we've put a lot of money where we see really excellent value, and our returns will therefore be different from the index. So if you think that a value investment approach, i.e. buying companies when they are cheaper than where they normally trade, is an interesting, attractive philosophy. If you are looking for a higher income than the overall market, that might appeal to you, but each investor has to think about what they're comfortable with doing.
And despite the fact that the UK market outperformed the US market last year, we're still seeing fairly low sentiment towards investing in the UK. What do you think needs to happen for that to pick up?
Yeah, I mean, that's the multi-million-dollar question, isn't it? I think it's been extraordinary how strong the UK market has been and how little commentary there's been about that, because the UK has outperformed significantly America and actually much of Europe in the last year or two. I think it becomes self-fulfilling at some point. If the UK can continue to outperform, at some point people will start to realise and notice that. I think on top of that, what you are seeing is a lot of takeover activity in the UK because the market's so cheap. A lot of buybacks, something like 45-50 billion pounds a year of buybacks in the UK. So if you stop seeing people selling the UK, the market will almost certainly, or should, go up because of all that pressure of people buying and takeovers. So I think at some point it should correct, i.e. people should get more excited about the UK, but it's very hard to say what's going to change the narrative. And I think there is the media seems to focus on the negatives about the UK, whereas I think there are lots of challenges elsewhere in the world, whether it's politics, whether it's economic issues, and the UK doesn't look that different when we look at it to many other countries, and in some ways more attractive, certainly on valuations.
You've mentioned that Merchants Trust has a long-standing dividend track record. It's increased its dividend every year for 44 years. How important is maintaining that dividend track record? And could you run through the strength of the revenue reserves that you can dip into if there's an income shortfall?
Yeah, and that's a great question. It's a really key objective of the trust and the board of directors who hold us to account. We look at it, and the board looks at it at every board meeting, the income trajectory and how it's shaping up. The dividend is covered by earnings, fully covered, has been for the last 3 years. We're not one of those trusts that's been paying dividends out of capital. It's fully paid out of earnings or of retained earnings in previous years as reserves. The reserves are very significant. They're about 60% to 70% of a full year's dividend, so they're very substantial. And the income trajectory of the portfolio looks good at the moment. Many companies, because they're paying special dividends, because they're doing buybacks, their dividends often very well covered. So when we look at it, we feel pretty good about the income outlook at the moment.
Another tool that investment trusts have is the ability to gear. Could you run through your approach to gearing and what are the current gearing levels?
Yeah, so the Merchants Trust has some long-term borrowings. The gearing is about 12 to 13% at the moment. And the idea behind that is if you can borrow money, and our average cost of debt is about 5.2%, if you can borrow money at 5.2% and make a higher return than that in the market, then you're adding value for shareholders. And at the moment, the dividend yield on the portfolio is nearly 5%. So we need very little capital growth on top of the dividend to make that accretive. And so I think gearing to a modest and conservative level makes a lot of sense for long-term investment trusts that can take that view that has permanent capital.
And Simon, the last question, which we ask every fund manager, is: do you have skin in the game?
Yes, I've got significant investment in Merchants Trust, actually on your platform. So thank you for that.
Well, that's great to hear that you're an Interactive Investor customer, and thank you for your time today.
Thank you.
And that's it for our latest Insider interview. For more videos in the series, do hit that subscribe button, and hopefully I'll see you again next time.